Large moves on the 10-year. They have pushed yields closer to uninverting, but that might not be a good sign for the economic outlook. Yahoo Finance's markets reporter Josh Schaefer is here with a closer look at the recession indicator. Hey, Josh.
Yeah, Brad. So I spoke with the founder of the recession indicator last night, Professor Campbell Harvey, and I asked him, what happens when these yields uninvert? You remember back since last November, we've been talking about the inverted yield curve, meaning that yields on the three-month Treasury have actually gone below what we see higher than what we see on the 10-year Treasury. So that's been inverted, that yield curve. But what happens when we uninvert? So if you look right now at the inverted yield curve, right now we're showing you the 10 and the 2-year, and you can see that it's getting closer and closer to uninverting at the end of your screen on your right there. But what's interesting here is what's happened before the last 4 recessions, those gray vertical lines we have on our chart here. Before the last 4 recessions, we've actually seen the yield curve uninvert. So what happens when it uninverts, and the key to understand here that Professor Harvey was talking to me about, is why it uninverts and why we're seeing the yield curve potentially uninvert now or in the coming weeks. It is not uninverted yet, would be the move in the long rates. We've seen a big move in the 10-year yield. What they call this is a bear steepening. And what we're talking about with that, of course, bear and bull, bear not normally good for stock investors, right? And Professor Harvey gave me basically 3 specific reasons why the bear steepening and that rise in long rates is not good. So for one, it's the most closely related rates to consumers and businesses. So it impacts both consumers and businesses, because when we're talking about long rates, we're talking about 10s, 20s, 30 years. Well, what's the most common 30-year rate we think of? We think of a mortgage rate, right? That highly impacts consumers. It's also going to cost more for businesses to get loans when they come back to market over the next couple of years. That will shrink their profits. If their profits shrink, they might have more layoffs. So that's something to think about. And then again, the long-term lagging impacts is something we keep talking about with these yields. When we think about long rates and those being long-rated interest rates that people are taking loans out on, Professor Harvey was kept harping on the fact that that's going to be something that we don't see necessarily right now, but something that we're going to see coming down the pike. That's what actually has him in the camp of he thinks the central bank should be talking more about rate cuts right now than rate hikes, which also stuck out to me.
All right, Josh, great job analyzing all of that and really drilling down to exactly what this could mean here, not only for the broader economy, but also for our viewers, for our consumers. So thanks so much, Josh, for that. We want to dig a little bit deeper about the movement that we have seen in rates, the rise in Treasury yields most recently, and getting to the latest on this rate debate. Has the sell-off in bonds gone too far, or is higher for longer here to stay? Now, against this backdrop, investors are bracing for key data to shed light on the strength of the U.S. economy. We also want to know whether or not fears of a recession is going to be enough to steer the Fed away from future hikes. To break all of this down, we want to bring in Blake Gwinn. He's the RBC Capital Markets Head of Rate Strategy to weigh in on all of this. Blake, it's great to see you. So we just heard from our reporter, Josh Schaefer, just about an uninverted yield curve, what exactly that could signal. I'm curious to get your perspective on the implications of that and exactly what you're watching or expecting as we do see that scenario potentially play out.
Yeah, I thought he did a great summary, by the way, on kind of what's driving it. And I think the differences between the steepening that we're seeing now and the steepening that you typically see into those recessions, because that is, we usually see those pivots to a steepener environment in a bullish environment where the market is starting to anticipate and price in cuts that are coming from the Federal Reserve. And here, what we've seen over the last month and a half, basically back to late July, is actually something that's much, much different. It's long end rates rising while the front end is relatively steady. And I think that for most of that move has really been about supply and demand. I think that's one of the factors that comes up the most. When the back end tends to go up and the front end is remaining steady, we tend to think of that. You'll hear people refer to term premium. That basically just means any move in yields. It's not really directly related to the near-term Fed expectations. It's kind of interesting to say that because with all the focus on the Fed and this kind of higher for longer, a big piece of the rate move we've seen has actually not been about a repricing of Fed expectations. Some of it has come with the market pricing out cuts, but we haven't really, revisited the idea of terminal. It's not like the terminal rate is continuing to move higher. That's what we saw through, most of the beginning of this year into 2020, back to 2022. This is really more about these kind of long-term rates and the term premium, not about the near-term Fed pricing. I think a lot of that has to do with supply and demand outlook. There's a lot of Treasury supply coming. Deficits have surprised to the upside. There's a lot of concerns about who's going to buy all that Treasury debt. And I think that's led a lot of people to think that this, term premium driven move can continue as that supply continues to come online and markets just struggle to absorb it.
And Blake, even as we think about the expectations going into the next Fed meeting too, and how this could continue to impact yields, much of the anticipation, at least from the CME Fed Watch tool, is that there's going to be no change, that there's going to be no decision that would ultimately kind of move rates higher at this next meeting. So how does that calculate into the yield move that we're watching right now?
Well, two things. So let me just tell you kind of where I'm at on the Fed. I agree with what's basically priced in the markets, that they're going to pause in November. I think the Fed speak we've seen over the last few weeks heading into the blackout period ahead of this shows a Fed that is very reluctant to continue rising rates. We just heard a lot of discussion about, what higher rates, higher term premium can mean for consumers, for borrowers. And I think the concern that you're seeing from Fed members is that they are looking at these higher rates and thinking, hey, this is doing some of our work for us. We don't need to continue hiking rates. If longer term rates are moving up and these mortgage costs and other ways that it impacts the economy, if those are starting to get tighter and those financial conditions are tightening on their own, we need to do less. So I think you've seen that kind of vibe from the Fed speakers over the last 2 weeks, where they seem like the bar to continue hiking is very high. As far as what that means for these moves continuing, I think with the Fed on hold and not wanting to hike more, you do take away some of the upside risk to front end yields. But I think what's interesting is after Powell, we actually saw curves continue to bear steepen after he delivered what I think was widely viewed as a dovish message. Typically, when you get dovish Fed speak, you actually see a bull steepening because people start to price out those front end, additional Fed hikes. They start to price in additional cuts. But this time we saw a bear steepening. And I think that's because when you couple the strong data that we've had with a Fed that seems very resolute to not hike again, that starts to add some upside risk to long-term growth and inflation. And that manifests itself through higher back-end yields, through higher term premium, through a steeper curve. So I do think with the Fed on hold, if the data continues to be strong, as we saw with NFP, CPI, retail sales, if that kind of strength of the data continues and the Fed still says, hey, we're not moving, it's possible that this term premium move could continue, except now it's more about upside risk to inflation growth than it is supply and demand for Treasury securities.
Well, when we talk about the supply and demand issues, though, and the Fed's role or diminished role potentially here in all of this, how do you see that? How much of that is playing into the volatility expectations that we could see play out within Treasuries, within yields over the coming months? I mean, when we're trying to figure out, I guess, the biggest drivers here, how should investors be looking at that?
So, I think, if we're referring to the Fed's balance sheet policy, QT obviously puts pressure on Treasury. They have to fund that hole. So every month when, the Fed is allowing these securities to roll off its balance sheet, that does create a funding need for Treasury. And I think what really kicked off a lot of these supply and demand concerns is that the last refunding announcement that we had from Treasury, which was back at the very beginning of August, they surprised a lot of people with how large they were forecasting the deficit. I forecast this stuff very closely, and I know a lot of other people who watch this very closely were surprised by the deficits they put out. And that caps off, I think, almost a year where every single quarter it seems deficit expectations, issuance expectations have continued to go higher. Now, a piece of that's related to QT, it's related to Fed balance sheet policy, but there's also a lot of it that's related to the fact that rates have just gone higher, meaning the amount they have to pay on Treasury debt goes higher, cost of living adjustments to Social Security payments, a lot of other reasons why those deficits have continued to go up. But I think from here, I feel like the risks are a lot more two-way. I think we've basically caught up. We, meaning the street, investors, have caught up with where we're expecting those deficits and where the supply is supposed to be. And even though it's going to continue to come online, I think we at least now kind of know we're all on the right side of where those deficit expectations need to be going forward. So I think we have less volatility coming from the supply and demand channel than maybe this kind of upside risk to long-term growth and inflation, as I was mentioning before.
Interesting. Want to digest there. Blake Gwinn, always great to get your perspective. RBC Capital Markets head of rate strategy. Thanks so much.